in life, we always need some type of protection. In 2024, we're going to talk about the different protections that you may need. Mortgage protection, life insurance, and real estate, if you didn't know that. Welcome a special guest this week on Hump Day Real Estate with Ken Dellin and DMV. Who do we have here today?
Melanie Jackson, and thank you so much for having me on, Mr. Kendall.
I appreciate you for coming on. Tell the folks, you've been on before.
It's a pleasure. The last time I actually was on, I was a loan officer, so I have an extensive background in real estate. And so at this time, I have a plethora of services that I provide. I'm no longer a loan officer, but I do still do a lot of things that are surrounding real estate. What I find is it's very important in the real estate space to educate people, especially the African American community, on how to actually protect the asset that they bought. As you know, and as I know, I mean, out here in this world, or should I say out in the industry, a lot of the clients that we were serving, they would buy a house and get a mortgage for 30 years. And typically there was two people on the mortgage. Now, what happens is that mortgage is 30 years. They qualify for the mortgage with two incomes. So in all actuality, that would mean that two incomes is going to pay the mortgage over that time period. But what happens is often enough, we do not prepare ourselves in case something was to happen. What I find is that people as a whole look at insurances, especially life insurance, as like an omen. I mean, they'll pay car insurance. They'll even have insurance on their cell phone. That's no problem. Even homeowners insurance. Insurance is used in case something happens, just so that the people or the person can be made whole. So, far as the actual life insurance piece, that's where it gets a little fuzzy. And that's where a lot of times people do not want to really come to grips with the realization that, hey, that is actually something that could take place, or no, not could, will take place in our lives. So what I found is, as I was in the industry for a long time, I've been in real estate since 1996 in various aspects of real estate. And what I found is this: when you are facing a 30-year mortgage, that means that for 30 years, you have committed to the bank that you're going to pay on time every month. And there might be two people on that mortgage to qualify for that loan. What happens is you are now banking that two incomes is going to be coming into the home. Typically, you don't even think about that one person may not come home. So what I educate people, because I have an educational platform that wants to be able to get the information out, so that people understand that life insurance can be used as income protection. That's why I started with replacing the income that's not coming home. So when we're talking about mortgage insurance in the realm of real estate, as a realtor yourself, you actually put the client in the home. As the loan officer, as I once was, I would qualify the client for the mortgage. So once we were done with that client and they were happy and they had the housewarming and we sent them on their way, we touched base with them every now and then to see how they were doing, but not even giving thought to what if there was something that actually happened to one of them? What would happen if an income was lost? So when I started researching this whole thing around mortgage protection, so that I want to go back a little bit so that everybody knows what I'm talking about. I'll go in full circle. Mortgage protection is a vehicle that's going to allow you to have your mortgage paid off if something was to happen. So you have, say, $350,000 mortgage. So therefore, your policy would be worth $350,000. Okay. So if by chance one of the people doesn't come home, whether it be the wife or the husband, the entire house would be paid off because that loan would be paid off. But what I educate people on is to actually have maybe 450,000 or maybe 400,000. That way, there's a little left over to pay the taxes and the insurance. What I found is that a lot of times people have heard of tax sale. Tax sales typically happen when there is no mortgage on a property. So if you're going to utilize the benefit of mortgage insurance to have the house paid off, now there's no covering far as having those taxes and that insurance paid. So if whomever's going to be left, in other words, you're going to replace the income that was lost if somebody doesn't come home, you also want to safeguard that person with enough money to pay those taxes and the insurance as well for a little bit as well. So you figure you are actually solidifying a large amount that that person that's left here doesn't have to worry about. Because of course, the mortgage is typically the largest bill that someone has monthly. I also would think of it as utilizing it for generational wealth, because if in fact it is a situation where you want to leave it to your children, then they have a free and clear house as well. And you would be leaving it an extra money for them to be able to pay the taxes and the insurance as well. So, like I said in the beginning, there's a lot of, I guess, negative words that are used, or should I say feelings around mortgage protection. And so what I try to do is educate our people, educate us as a whole on the importance of replacing the income. So if in fact you were to change the way that you think and not have it be in life insurance, but income protection, you are protecting, or should I say, you are replacing the income that's no longer there. And therefore, you could actually pay off the largest expenditure that you have monthly.
Gotcha. So one question: if does the person still have mortgage protection and life insurance, and how do they work together? If
They're one of the same, actually. So what happens is this: there's two ways of looking at this. So I'm sure once people buy houses, they then receive in the mail something called mortgage protection, because the mortgage protection company automatically sends, it's public record, whoever buys a house. Mortgage protection companies send out, hey, you can get mortgage protection to cover the mortgage that you just purchased. Okay. But with that mortgage protection, the bank is the beneficiary. So therefore, when that mortgage has to be paid off, the beneficiary, which is the mortgage company, they're going to be paid off. The house is going to be free and clear, but there is no money left over for those taxes and insurance. So what happens is I myself would use a term policy. A term policy is for what? A period of time. So if you have a 30-year mortgage, you would take a term policy for 30 years. Or you could do a stair step. You could take it for 10, 15, 30. Because in increments, the actual mortgage, as you pay it down, it's going to decrease. So you can set it up that way. And then that way the premium is actually cheaper as well. What I find is the average mortgage protection insurance would cost you about $83 to $100 a month. To pay off a $360,000 house, that's absolutely nothing. That might be 2 dinners out, maybe 2 dinners and a happy hour. And that's how people have to understand, or should I say, start thinking smart, because number one, you are allocating funds so that the biggest expenditures that you have is now paid off, is gone. And you also will have money left over. And that's the reason why I'm saying use a term policy, because then you can actually select the beneficiary. Again, the difference between a mortgage protection is that the bank is the beneficiary. With a term policy, which is going to do the same thing, you are going to be able to select the beneficiary. Does that make sense?
So which one? So I hear the two. So which one is the product that most people should get? Is it going to be term that covers, or is it going to
Correct.
be actual mortgage
Correct.
protection?
If they're educated, because see what's going to happen, like I said, once the person actually purchased the house, they are inundated with mail. Mortgage protection companies send mailers about having mortgage protection. Again, if they select the mortgage protection, the beneficiary is the bank. They have no more money left over for the taxes and the insurance. Whereas if they go on their own, or they seek out someone like myself, and they say, hey, listen, I was listening to Mr. Kendall's show. I heard everything that you said in regards to protecting this mortgage that I just received. I now want you to explain that. And so what my conversation would be is to explain to them the benefits of having a term policy for the period of time that they're going to have the mortgage.
So life insurance, not mortgage protection policy, is your
Correct.
thing. Gotcha.
Correct.
Okay.
Correct. Because when you're talking about life insurance, you can utilize the life insurance for the benefit of paying off that mortgage. So it's twofold, but it's all one the same. The only difference between the wording is the mortgage protection companies. That's why I'm emphasizing that they are the beneficiaries. The actual mortgage company is. The term policy, life insurance, you get to choose your beneficiary.
Gotcha. So when you choose that beneficiary, but at that point, then it's up to that beneficiary to take that money and apply it to and off that loan.
Yes.
So in other words, they have to choose responsible parties.
Most definitely.
Yeah.
Most definitely. And really, to be honest with you, it's when I explain it to a couple that has a mortgage and they're both on the mortgage, I'm explaining it as replacing the income that's not coming home. Because that means that either it's twofold. The mortgage could be paid off, or they have enough money to pay the mortgage until it's paid off, because they have the money that is the worth of the value of the property. Does that make sense? So they have income to be able to pay the mortgage. So it could be used, either they can pay the mortgage off, or they could utilize that income and replace that income that's no longer there.
So that's why you were also strongly earlier saying that I thought I heard you say something about if the house is paid off. So with it being a term policy, if I got a house that's free and clear, something happens, I'm covered. That person was covering the taxes or whatever. The term policy kicks in. You still have money to pay for the all of
Taxes
those
and interest.
things.
Correct.
Gotcha.
Correct. Because like I said, the most times that people get their house is taken for tax sale is because there is no mortgage. Because what typically happens is when you have a mortgage, the mortgage company, the taxes actually override the mortgage. So the mortgage company is always going to make sure those taxes are paid. So when you have a mortgage, you don't have to really worry about the taxes and the insurance because the mortgage company is going to pay them because it overrides their mortgage. Okay. But if there is no mortgage, that means that somebody could come along if you don't pay the taxes and buy the house for tax sale.
Which is also the reason why within the last 10 years, I would say never pay your house off.
That's right. I tell you personally, I probably would pay my house down to maybe 50,000. And then that way I'd have a low payment. My mortgage would be paid. I mean, my taxes and my insurance would be paid. And then if I was to get into financial trouble, I know for a fact my taxes and not my insurance is being paid, because of the fact that the mortgage company is always going to make sure that those taxes are, and that insurance is paid. Because what happens, well, years ago, I've been in real estate since 1996. And when I was a loan officer years ago, they did not require you to have homeowners insurance in your payment. And so at times, people would let the homeowners insurance lapse. What the mortgage company would come back and do is they would do a forced place insurance. And that was extremely expensive. That means your payment went up. And the reason why they did that is because they're not going to let people stay in their secure, their because it's still secured by the loan. They're not going to let anybody stay in the home and the house not have any type of insurance.
Yeah. So now
It's called forced place.
Gotcha. And we're talking about homeowners right now. Is this the same opportunity to get this term insurance, life insurance for an investor and their properties as well? Or is this
Everyone.
just
They don't discriminate. Everyone.
so they're just so how would it, do you know how that looks though? So I got 10 properties, I go and get term, I would get what, 1 million, 2 million
Yeah.
term insurance policy, and then just to make sure it covers all of
Exactly.
those.
I have a
Gotcha.
client right now. He actually had 5 properties. So we put all 5 properties. It came out to be like 1,500,000. And then as we were doing that, going through the process, he purchased another property. So we moved it up to 2 million because he knew he was going to be buying other properties so that he could literally buy $2 million worth of properties and they would all be paid off upon his death.
Now, is it still the same? Because most people, when they're buying those properties, should be putting them in LLCs to protect themselves. Is it still the same thing?
Yes, it is, because the LLC is owned by who?
The individual.
Exactly.
Or sometimes not, but what if they're doing that whole big asset protection where the LLCs are actually owned by a C Corp, this, that, and the third down the line? Is it at some point because the individual owner is still an owner of something in there that still
Exactly.
plays a part?
Plays
Okay.
a part. Yeah. I mean, ultimately, that could be a little bit different and a little bit tricky, because of it being structured that way. But there's always ways to try to figure out how to actually go about doing that. Most
Gotcha.
definitely. Hmm.
Gotcha. And then looking at all this protection, life insurance, mortgage protection, how do you feel about me saying that real estate is also a form of protection?
Now, when you say real estate is a form of protection, in what light?
Wealth and finance and your financial life. Because when I'm mentioning that is that okay, so we grab at people every year and we say, hey, you need to buy a house, this, that, and the third. But I don't think they understand what buying a house, why the landlord is your landlord, right? And the landlord is your landlord is because he's trying to protect his financial future.
That's
And
right.
what he's using to protect his financial future is that real estate.
That's right. And that's because of the equity, because equity grows. I know Years ago, it was 3% every year. Um, and then it went up to 5, and then it shot up to 9, and so I'm not quite sure where or how much the equity grows each year currently. Are you familiar with what the equity grows? How much it
Well,
grows
what
each year?
it's still 3 to 5% a year, but within the last 3 to 4 years, it's probably have grown 50 to 30%.
Okay, great.
Yeah.
So you figure that equity is actually being every year, that equity is getting more and more and more. And then that's what I cornered phrase money in the walls. That's money that you can assure that you can go get. Now, there's a bigger problem. There's an elephant in the room because if you have equity, i.e., money in the walls, you have to have what? Good credit, because you cannot obtain that money unless you have a good credit score, at least 680. Well, I think it's 680 at a credit, and we're not going to go all into that. But if you want to obtain the money out of the walls, i.e., equity, you would need to keep your credit up so that you could actually utilize that money, because you have to be able to borrow it. Should I say, do a refinance, cash out refinance, a HELOC, which would be a second. Some people even do thirds. So whatever the case, you'd have to keep their credit up, or should I say high enough, at least a 640 credit score on all three bureaus. That's Equifax, TransUnion, and Experian. And that's a whole new, a whole nother, whole nother show for you.
Well, here's the biggest thing on that though is what I've learned owning multiple properties is that just having those properties and paying the mortgages, so you can kind of lapse on a lot of other things, and your score will stay pretty high just by owning those properties and maintaining those monthly payments on those homes. So that's big within itself to also help you maintain that higher credit score. Now,
Yeah.
let's speak on another thing though. Um, Homes with when you talk about buying a home, don't let, especially if you want to talk about protection for down the road and then equity, don't and passive income, don't let the low credit score hinder you from thinking about getting
Correct.
into this thing, because
Correct.
there is these days there's commercial lenders, and with the traditional lenders now we have something called DSCRs, and those loans are being provided based on rental income
Mhm.
and not the actual credit report.
That's right.
So, but you do have to have, and with anything, when the credit is an issue, you just got to have more money. So I tell this to everybody I talk to: whatever your financial problem and whatever your credit issues are, just go figure out a way to make more money, and
There you go.
you still can get in the game. It's just getting more money. So
You know, it's odd that we're segueing into the money aspect and what you can and cannot do, because what I find is this: because the financial literacy as a whole isn't taught, people don't quite understand how money can work and how it can actually be utilized and obtained. So, what people need to really do is concentrate on, okay, this is what I want to do, and this is what I need to do to go get what I want, because there's many places that you can get the money to be able to get the piece of real estate. You know, there's the hard money lenders, like you said, private lenders, like you say, commercial lenders. And so there's all type of avenues or outlets that money can actually be obtained. So it all depends on where you're trying to go and what you're trying to do in regards to where you want to actually be and put yourself in the position to be able to win.
Melanie, have you heard of crowdfunding?
I have, but now with crowdfunding, isn't that where a group of private investors put their money together and lend it out?
Yep, so that's just like you and I and a couple other people that, and they have different sites out there that you can gain access. I've sold a 3-unit apartment building to a guy who went and got crowdfunding because he knew
Wow.
that this building was in a prime location. And
Awesome.
he was actually a real estate agent showing the place to somebody else. After he left out there, he said, "Don't worry about it, Marcel. I'm going to buy this building myself."
Awesome.
And he came back. He went and got crowdfunding to buy that building.
Wow. Wow. Now that's thinking outside of the box, and now that's a great way of thinking about things. But like I said, often enough, when people do anything, if they have an exit strategy, hey, with everything, you have to have an exit strategy. You have to have a beginning and an end. You have to figure out where you're going to get the money to do what you want to do, and then you have to also figure out what you're going to do with what you're buying, and then also, hey, if something was to happen, how to get out of it as well.
Oh man, and that's and that's real big because you kind of a lot of times you have to start with the end in mind.
Hmm.
Right?
Hmm.
And if you start with the end in mind and you put all these things in place, then the future, of protection of what we're talking about, you'll set yourself up and your family um, for success with your financial future. So, Melanie, I appreciate you again for stopping by. Tell the folks how they can reach you.
Well, I am accessible. My number is 443-506-7929. I welcome any calls, any questions. I do have appointments that are on Zoom. So I want to be able to reach the masses. I mean, you figure when I sit in my office, I am in four walls, but on a show like this, it's called exposure. I just need people to understand I'm out here. I really have a passion for helping people. I mean, my background, like I said, has been in real estate, but I spent a lot of, well, what is it, about 10 years as a housing counselor, foreclosure prevention specialist. So it is an actual passion of mine to actually help people to be able to navigate through difficult parts of their lives. So my number again is 443-506-7929. Please give me a call if there's any questions that you may have.
Investors. I haven't heard Melanie speak about what she spoke on in regards to the term policy for investment property. It might be something that you might want to call her to get more information on because I haven't heard anybody speak on that at all. But Melanie, once again, I appreciate your wealth of knowledge on the insurance piece and real estate and all of your because what folks don't know as well. She said loan officer, but she was also a housing counselor. Still wears that wears that hat. But once
Many
again,
hands.
but once again, I thank you all for chiming in on another Hump Day Real Estate with Kendall in the DMV. And we're signing off. We'll see you again next week on Wednesday. Melanie, thanks again. Hope to see you on the show again soon.
Not a problem.